going to record it because the people that can't make it today will probably be interested in seeing it at a later date. So um, again, if you have questions, feel free to ask them in the chat, in the chat bar, and I will try to answer them the best I can. We may not have all the answers for you today if things get really interesting and you have some questions that we can't answer. We certainly can get back to you by going to our expert partners from various investment firms and getting their take on the question that you might have. So today, I've got the Steve Jobs look. Anthony said that's who I look like, so we'll go with it. I guess that's a compliment. I'm going to keep today's discussion really general, not too technical, so that regardless of your investment experience or savviness, everyone should be able to get some value. We're going to give you the facts. We're not going to give you the headline news where it's not biased. But we've been reaching out to clients over the last several weeks and thought this would be a quick and efficient way to convey our message, especially after the Federal Reserve meeting on Wednesday, where they raised interest rates 50 basis points or 0.5%. So let me just start by saying the economy is not terrible. It's actually really, really good. And that's the problem. It's actually doing too well, and consumers and corporations are overall very, very strong. So the dilemma is Jerome Powell and the Federal Reserve want to slow things down and take away some of the easy or free money policy that they've had over the last few years during the pandemic. So just kind of recap, at the beginning of this year, we were telling clients that 2022, we were kind of anticipating it'll be a decent year. We weren't expecting double-digit returns, but we thought, modest single-digit returns were certainly on the table. That changed as soon as Russia invaded Ukraine. Oil prices spiked. They tripled almost overnight. And the uncertainty of World War III caused a market sell-off. And certainly we weren't expecting Putin to invade Ukraine. It was a very unlikely event, but I guess you can't anticipate everything, especially with some of the insanity that's been happening there. So this year to date, the S&P 500 is down about 15%. The NASDAQ, which is tech heavy, is down about 25%. And bonds are down about 11%. And it's been grinding. It's like death by 1,000 cuts. It's just been kind of a roller coaster, and you get a little bit of hope one day when the market might be up 800, 900 points, and the next day it's down 1,000 points. So it's been definitely painful to watch, and it's like that for all of us. There's no place that's been a safe haven except for cash, I suppose. Cash and oil, quite frankly, oil's done really well since oil prices tripled in a few months. You can imagine oil's done extremely well. But the problem with chasing that at this point is that if the Russia-Ukraine conflict ends somehow, you would imagine that oil prices will drop significantly, and a lot of those gains that were had over the last 4 or 5 months will disappear relatively quickly. So that's what we're facing. So what are the problems? Why are the markets and investors and algorithms selling off the way they are? I'll go through the multiple reasons. One is inflation. Much of inflation has been created by a lack of supply. So costs increased to those that wanted to pay up for that limited supply of products like computer chips, steel, lumber, real estate, homes, and so many other products and services out there. So when you have a lack of supply, but you have all this demand, you can imagine that you can raise your prices for, the few pieces of inventory that you might have are being purchased or wanted or demanded by so many people. You can raise your prices, and that's what's been happening out there. Interest rates have doubled over the last 6 months, even regardless of that, the fact that the Federal Reserve has only raised rates twice this year by 0.75%. Rates have gone up. The 10-year, the 30-year have doubled. The 30-year mortgage rate is now back over 5%. It's like 5.3, I believe, is the 30-year mortgage right now. It was in the twos not too long ago. Bonds are down, similar to stocks this year, because values drop when interest rates go up. So the bond market had anticipated rates going up, and instead of going up gradually, they spiked. They went up quickly. They went up in a matter of 3 or 4 months. Unlike what the Federal Reserve plans to do, is they plan to raise rates over a period of time, over probably the next couple of years. But the bond market had nothing, had a different game plan in mind, I guess, and decided, hey, we're going to anticipate where rates are going to be, and they're going to go up significantly real quick, and thus bonds have lost value in relation to where they were 4 or 5 months ago. So again, there's really no place, unlike typical diversified portfolios, when you have at least some cushion when the stock market goes down, your fixed income investments cushion the fall a little bit. That's not the case this year. Both bonds and stocks have gone down together. The good news there is probably all of or most of the interest rate hikes in the bond market are built in. So bond values should stabilize from here going forward. So I mentioned inflation, interest rates, the Ukraine-Russian war. Again, it was unlikely that Putin would invade, but it happened. Now pressure is being put on Russia with all sorts of corporations have basically stopped doing business in Russia. So they've sanctioned themselves from doing business there. They weren't forced to do it, but I can only imagine if you thought our pandemic and what was on our grocery shelves was bad during the pandemic, I can only imagine what Russia is facing, what the people of Russia are facing right now, and what's likely to come. So I'm sure there's inventory shortages that will take years to recover from. There's still closures in China because COVID is still having an impact there. And because of that, our supply chain, as you know, a lot of our goods are imported from China. There are a lot of job openings and not enough workers to fill them. Today's job report was still strong with 430,000 new payrolls added. That's the fifth item that is, I guess, kind of good news, but it's also bad news when it comes to the fact that the Federal Reserve has to slow things down and damper those inflation fears. And I'm sure there's more bad news out there, but heck, I'm not here to depress the hell out of everybody. I just want to give you the facts. So what do we anticipate happening? Is there any good news? Yeah, there's some good news. What's happening now has been needed. Nobody wants to pay exorbitant amount of prices for their real estate or their lumber or food at grocery store. So it's caused pain for everyone, pretty much worldwide. And unless inflation gets under control, it's going to continue to cause more and more pain and likely, you know, bigger. If we go into a recession, if we didn't control it, we'd have a bigger recession later on. So inflation will get under control. A recession might be necessary to get some layoffs happening, to get pricing under control, to get the job market a little bit more under control. And you'll hear on the news the term recession. It'll scare the hell out of you. Quite frankly, a recession is not a bad thing. A recession is 2 quarters of growth slowing. And that's really it. If a recession happens, it's not the end of the world. We've had recessions where stock prices can go up. So don't let the news scare you. If a recession is going to happen, as long as it's not a long, drawn-out recession, if it's a couple of quarters, not a big deal. Supply chain issues should get better over time as the pandemic continues to subside. If more supply can meet or exceed demand, prices will usually drop. So I mentioned inflation, supply chain. Number 3, we're focusing on the fundamentals and being diversified. While the markets are whipsawing, focusing on good quality investments have always proven to be tried and true, kind of the Warren Buffett approach. I'll also add that they're usually the first to rebound when things do turn around. 4, we have midterm elections coming, which is likely to cause policymakers to make decisions to help the economy, help investors in the short term to win votes. Longer term, recession is not good for politicians, but short-term recessions can be healthy. And the government doesn't want interest rates to skyrocket. You know, interest rates skyrocketing, going to 7, 8, 9, 10%. Can you imagine the amount of debt that the government has if they had to pay, 5 times, 4 times what the interest rate was on their debt now? It would be political suicide for that to happen. So I would imagine there's some pressure on the Federal Reserve to try to keep interest rates at bay for as long as possible. 5, the housing market remains relatively strong, which, regardless of interest rates and the fact that demand is still outpacing supply, it will slow. An interest rate of 5.5%, 6% can add hundreds of dollars to a monthly payment compared to where they were a few months ago. So the consumer, contractors, and all the peripheral businesses will likely continue to be strong in the construction and infrastructure business for the foreseeable future. It will slow down. Will prices plummet? Will it be a 2008 where housing prices crashed? I doubt it. I think housing prices will subside. I think they might come down a little bit, but I don't expect a 2008 crash in housing by any stretch. There's already signs that the real estate market's starting to slow, with more inventory coming online, less activity on sites like Zillow and Redfin, mainly because of a quick rise in interest rates. As a matter of fact, Zillow announced this morning that their web traffic has decreased over the last quarter. So we're starting to see it. Things that are normally financed will likely slow over time. Things like cars. Car prices are People are paying sticker and maybe above sticker right now, which is kind of unheard of in the car market. Homes are selling above asking price and having bidding wars of 20 or 30 people bidding on the same home. Boats that are financed. So all those interest rate sensitive type um, uh, niceties like cars and boats, even homes, likely will slow down the demand in those areas. 6, the balance sheets, company balance sheets are really strong with little debt. A lot of companies refinance their debt during those low interest rate environments and are making record profits. 7, you have to ask yourself, where's the money going? If everyone is selling, or all these algorithms and pension funds and trading platforms are selling off, where's the money? Where are they putting the money? So you have to ask yourself, are they going to cash? Are they going to real estate? Are they going to bonds? All of those, I mean, cash is holding its own, obviously, but those other asset classes, including Bitcoin, have dropped in value. So that money is sitting on the sidelines. A lot of the trading that you're seeing is due to options contracts, margin calls, things of that nature. So it's just computer generated trading. I talk to clients all the time. I talk to friends that have other financial advisor. I ask them what they're doing. Everybody's kind of sitting tight as long as they're comfortable with their portfolio. And the thing is, people don't sit in cash for very long, especially if they're not making a whole heck of a lot of money. So that money will eventually go somewhere. Will it go in bonds? I don't know. Maybe, depending on where interest rates are. Will it go in Bitcoin? I tend to stay away from Bitcoin because I just don't understand it, don't feel comfortable with it. Will it go in the stock market? I think at a certain point, people will feel really comfortable getting back in because valuations are so attractive. Yeah, the frothiness has definitely come off, and now there's a ton of bargains out there. So my feeling is that this cash will go into the market. I don't think it's going to go in fast. I think it's going to be a gradual grind, and the returns will be surprising to those that are sitting on the sidelines. They'll not have even realized the market's doing okay because it'll be, like I said, a 1/4% here and a 1/4% there, and it'll just gradually go up, and then it'll sell off, and then it'll gradually go up, but it'll take some time. We're thinking probably the latter part of this year, things will start to improve. Some of the fear will have subsided. A new headline will have taken over. I don't know if it'll be the elections. I don't know if it'll be Russia. I don't know exactly what it'll be, but certainly things will change. It kind of reminds me of 1994. If I look at who's on this, some of you were actually clients back then, so you remember those times, although it's been a while. But in 1994, the market sold off, the bond market sold off, and by 1995, the stock market hit new highs again. So it does remind me, past performance is never a guarantee of future results, but it does remind me a little bit of 1994. The other part of piece of good news is that we're probably going to be able to get decent rates on things like CDs and bonds over the next 12 to 18 months, where we really haven't touched a lot of them because of the low interest rate environment that we've had. We're going to be looking at those types of investments because they're going to be looking more appealing going forward. The job market, technology will probably help to offset some of the shortage of employees. As the economy starts to slow down, the need for employees will also start to soften. We may start to see some layoffs. Again, that doesn't sound like a good thing, but it will be a good thing. And lastly, those people that decided to stay home during the pandemic are going to find themselves not being able to afford to stay home, especially if these prices for consumer goods and groceries and automobiles stay elevated for a period of time. The other thing that people need to think about and realize is that towards the end of a downturn, the end of a market downturn, we start to see what's called capitulation. And what that means is there's high volatility, big swings as real fear starts to set in. I had a conversation with a client yesterday, been with us for 20 something years, and we were kind of laughing that I was telling her I was talking to some clients, and although they understood and were concerned, I didn't feel like anybody was really, really panicking yet. So I felt like that capitulation isn't there. We're probably not quite at a bottom yet. We're close. If anybody, I said it earlier, I wasn't going to talk about technical things today, but I just want one piece of technical information here. If anyone follows the VIX, V-I-X, if you type it into Yahoo Finance, it's a measure of volatility. And as the VIX goes up, that volatility goes up, stocks go down. And as the VIX goes down, stock prices go up. So it's a real good tool for us to see what investor sentiment is. Right now, it's pretty abysmal. The VIX is above 30, which is positive for stocks. When it gets down into the low teens, 12, 13, that means complacency has set in, and that's usually not a good thing for the stock market. So what are our recommendations? And after I talk about these or some of our plan of attack, I'll open it up for questions. Our plan of attack, stay diversified. We're going to be careful of interest rate sensitive investments. As an example, real estate, utilities are interest rate sensitive. We really like the financial sector. It looks really interesting at these levels, and banks make more money as interest rates go up. We want to invest in disruptive companies that change the way we live and work and do business. We want to invest in blue chip companies, profitable companies, companies that have pricing power. We want to invest in well-rated mutual funds and exchange-traded funds. We want to keep an eye open for better opportunities. If we have an investment that we've lost confidence in or feel differently about, we're going to look for other opportunities that look more promising. We're not going to make knee-jerk reactions or make knee-jerk decisions based on the short term that might impact us and you over the long term. So even though some of this stuff looks ugly, there's still a conviction. It might be because of pricing power. It might be because we feel the market's got it wrong for some reason. So, and it's not just our opinion. We're getting other financial firms' opinions, other research department opinions, but we're looking at that stuff really closely, and we're going to write it out. There's really, there's no sense, in our opinion, for us to be liquidating assets at these levels. In hindsight, if we were market timers, we would have sold everything in January and maybe looked to buy back in at these levels. But I can tell you, over the many years that we've been doing this, we've had, I would call them experiments, with clients that decided to get out of the market. And we never talk anyone out of doing anything. So if we have a client that wants to get out, we'll give them the pros and cons. But if they want to get out, it's their money. We're going to get them out, no questions asked, and we're going to do it immediately. But I can tell you from our experience that the clients that got out and got back in later, and this has happened dozens of times, all of them except one situation, clients ended up getting back in at higher prices than they got out at. So we don't encourage that kind of timing. It just doesn't work. The one situation that it did work, I was actually quite astonished and pleased that it worked, but that was the rarity.